Tesla, the poster child of the electric vehicle or EV revolution, is taking a beating. Since its stratospheric peak in late 2021, Tesla's stock has taken a nosedive of a whopping 57%, leaving a crater of $735 billion in lost market cap. Talk about a range anxiety attack for investors. This mind-boggling drop comes at a time when the rest of the tech world is celebrating. Meta, Google, Amazon, and Microsoft are all cruising at all-time highs. So what's the deal with Tesla's sudden detour? It's not just the stock price that's giving Tesla a flat tire. Their financial performance is starting to sputter as well. Since late 2022, their quarterly revenue has stalled like a car with a dead battery. Gross profit, the lifeblood of any business, has dropped by 23%, and operating income, the money left after accounting for expenses, has taken a nosedive of 50%. Now, Tesla's net income might look shiny on the surface, but that's thanks to a one-time $5.9 billion tax credit. A bit like Sugar Rush that won't last forever. Remember the heady days when Elon Musk, the ever-optimistic CEO, promised Tesla would be a growth machine, churning out vehicles at an annual rate of 50% and aiming for a mind-blowing 10 million cars a year? Well, 2023 saw Tesla fall far short of that goal, delivering only 1.8 million vehicles, a growth rate of a measly 38%. And to make matters worse, analysts are predicting even slower delivery growth for 2024. Looks like that hyperdrive Musk promise needs a serious tune-up. Despite aggressive price cuts and tax credit incentives, Tesla is facing some serious headwinds. Lower interest rates, once a boon for car loans, are becoming a thing of the past as the Fed tightens its grip. This translates to higher monthly payments, making those already expensive EVs even more out of reach for some buyers. But Tesla isn't alone on this bumpy road. The entire EV industry is feeling the tremors. Startups like Rivian, Lucid, and NIO have seen their stocks plummet by over 90%. Their dreams of disrupting the auto industry facing a harsh reality check. Even legacy automakers like Ford are struggling. Their much-hyped F-150 Lightning is experiencing low demand, and Ford is reportedly losing a staggering $36,000 on every one they sell. That's some serious negative margin. So what happened? Weren't EVs supposed to be the clean, green future of transportation? Did we hit a charging station setback, or is this just a temporary speed bump on the road to EV dominance? Let's find out. Remember that heady time in late 2021? Electric vehicles or EVs were the hottest topic in town, with companies like Rivian strutting around with a valuation of $150 billion. That's bigger than Volkswagen. People were lining up for Teslas, happily shelling out record-high prices for the chance to be a part of the clean and green revolution. But then, just like a flat tire on a road trip, things screeched to a halt in March 2022. The Federal Reserve, in its bid to combat inflation, started raising interest rates from near zero, a move that sent shockwaves through the EV industry. Tesla, known for its aggressive 0% interest rate programs that made their cars more accessible, was one of the first to feel a pinch. With rising interest rates, those once sweet loan deals became significantly less sweet. Suddenly, the same shiny new Tesla that someone might have been able to afford before now came with a hefty 20 to 30% increase in monthly payments thanks to interest. This hit the higher-end models like the Model S and X particularly hard, as their hefty price tags translated to even heftier interest charges. To stay afloat, Tesla was forced to slash prices, a move that sent their gross margins, which is the difference between revenue and the cost of producing goods, tumbling from a comfortable 27% down to a less desirable 18%. While this price cut helped Tesla weather the initial storm, it wasn't a sustainable solution. Tesla, with its established brand and production muscle, was able to weather the rising interest rate storm, at least for now. However, the story wasn't as rosy for other less established EV makers. Take Lucid, for example. They launched their flagship Air sedan in 2022 with a price tag of a cool $140,000. But with rising interest rates and a changing market landscape, Lucid was forced to slash prices significantly. As of today, you can snag a base model Lucid Air for a much more palatable $69,990. While this might sound like a win for budget-conscious eco-warriors, it paints a grim picture for Lucid's bottom line. Each Lucid car sold now translates to a significant loss for the company. So rising interest rates certainly threw a wrench into the EV industry's plans, But it turns out that's not the only challenge facing widespread EV adoption. A recent study by JD Power found that while interest in EVs remains high, a significant portion of potential buyers, around 20%, are deterred by the higher upfront costs compared to gasoline-powered vehicles. Looks like price remains a key battleground in the EV revolution. While EVs remain a promising technology with a bright future, consumer interest seems to be taking a bit of a detour. Let's explore why people aren't exactly stampeding towards the EV charging stations like we might have expected. Take a look at the numbers and things get interesting. New York State, for example, has ambitious plans to make all new vehicle sales zero emission by 2035. A laudable goal for a cleaner future. But here's the rub. As of today, EVs only make up a measly 1% of registered vehicles on the road in the US. That's a far cry from the kind of widespread adoption envisioned by eco-conscious futurists. Even when we look at new car sales, EVs only hold a 6.5% market share. So what's the disconnect? Sure, EVs are becoming more affordable than ever, with Tesla and other manufacturers slashing prices to compete. But cost isn't the only factor influencing consumer decisions. Two major concerns are cropping up: range anxiety and the state of charging infrastructure. Those flashy headlines touting EVs with ranges of 300 to 400 miles can be a bit misleading. Unlike filling up a gas tank in a few minutes, an EV's real-world range can be significantly impacted by factors like weather conditions. Cold temperatures, for instance, can significantly reduce your driving distance on a single charge. And then there's the charging infrastructure. Finding a charging station, especially on a road trip, can be a logistical headache compared to the ubiquitous gas station network. And let's not forget the time factor. A quick gas station stop becomes a much longer wait when you're tethered to a charger. The early days of any new technology tend to attract enthusiasts who are willing to embrace the quirks and bugs. But as we move towards wider adoption, the focus shifts from cool new tech to reliable practical transportation. Tesla's plummeting full self-driving or FSD take rate is a case in point. Back in 2019, nearly half of Model 3 buyers opted for FSD, a feature still beta in testing. This suggests that early adopters were more willing to tolerate the limitations of an unfinished product. However, as the market matures, consumers are looking for a more polished experience. They want a car that delivers on its promises, not just futuristic hype. So what does this mean for the future of EVs? This isn't to say that the EV revolution is grinding to a halt. It simply means there might be a few more bumps in the road to widespread adoption. Manufacturers need to bridge the gap between the ideal and the real by addressing range anxiety and investing in a more robust charging infrastructure network. Additionally, focusing on a refined overall driving experience will be key to attracting the more practical-minded early majority consumers. A recent study by Alex Partners found that while 60% of consumers are interested in EVs, a significant portion, around 40%, express concerns about the availability of charging stations on long trips. This highlights the importance of addressing charging infrastructure as a key factor in boosting EV adoption. Alright, let's switch gears and talk competition. Rivian's dropping more affordable models, Lucid's introducing new SUVs, and legacy automakers like Kia and Hyundai are stepping up their EV game. While the rest of the industry is struggling, Hyundai saw a 40% increase in Ioniq sales, and Kia enjoyed a 65% increase in EV6 and EV9 sales. Sure, Tesla's been the leader so far, but legacy automakers might surprise us. Kia and Hyundai may not be at the bleeding edge of tech, but they know what consumers want. And don't count out Nvidia in the autonomy race either. They could give Tesla a run for its money. So what's next for the EV industry? Tesla might bounce back, but it's gonna be a bumpy ride. Rivian, Lucid, and others could still turn things around, but they'll need to adapt fast. Legacy automakers might not be as flashy, but they know how to please consumers. In the end, the EV revolution isn't over. It's just hitting a speed bump. But with the right moves, the industry could still come out stronger than ever. Thanks for joining us in this deep dive into the current state of EVs. What are your thoughts? Are you considering an EV for your next car, or are the challenges holding you back? Leave a comment below and let's get the conversation started. Remember to like and subscribe for more tech and auto content. Tech and